G'day and welcome to Lunch Money, the Christmas 2021 edition. Lunch Money is the social media and online home for workouts and capital raising professionals. Because I haven't been doing this every week, I've got out of the habit. But there you go. It's been an interesting year. We're at the end of the year, and there's been, I guess, winners and people that necessarily haven't won so much. If you're in the mortgage business, you've smashed it out of the park. There's been so much work around. We've seen property prices escalating, and anyone writing loans against property have done really well. Equipment finance people have done okay as well. If you're in the cash flow finance space like yourselves, your number one competitor has turned out to be the ATO and the federal government, and that's another story. If you're in M&As, you've been knocking it out of the park. And of course, if you're in corporate restructuring, that has been a different kettle of fish as well. So what we're going to do today is we're going to try and read the tea leaves and see what is in store for us as we swing into 2022. And we're going to do that with some hard data prepared for us by our first guest, Patrick Schweizer, who's been with us before. And then we're going to talk to Darren Anderson and Scott Langdon, who are going to help us understand the data and break it down a little bit. Without further ado, I'm going to introduce Patrick Schweizer. G'day, Patrick. How are you?
Hey, Nick. Thanks for having me on.
Now, Patrick, you're the data guru, is what I've called you. You are also the director at Alares. Tell us what has been keeping you busy lately.
Yeah, look, it's certainly interesting times at the moment. We've been very busy helping our users identify and manage their credit risk, both from in terms of their customers and their suppliers. And we just in the last little while, it seems certainly the amount of concern out there generally has just started to pick up again a little bit, and we're seeing a bit of that play through in our data as well.
Now, talking to you a little bit before we started, Alares is a relatively new company. How old is Alares?
Look, we've been going for nearly 5 years now, so 4 to 5 years.
Okay, but you're still growing effectively. I mean,
we are, yes.
Yeah. So I guess if you were a mature business, I guess you're sort of semi-mature, but if you're a fully mature business, then how you perform would track the economy, perhaps. But you're still sort of powering through growth. So tell us a little bit about how you've grown in the last little while. Just give us a good news story.
Yeah, look, when COVID first hit, one thing that it did is it put risk management right in the front of of people's minds and right in the middle of the radar, where sometimes when things are very bullish, risk management sort of pushed to the side a little bit, but it really brought it to the fore, and quite a few businesses out there were really clamoring to understand what else they can do to understand and mitigate their risk. So that certainly put a bit of a spotlight on us, and it's helped our growth for sure.
Yeah, I guess it's been so long. We've been in this dark mist of COVID. Mark 1, 2, and 3. We're hammering through the Greek alphabet, and I'm very, very happy that all of you non-Greeks out there are getting a bit of an education with respect to that. But when it's always been a question of how much risk is out there. There seems to be growth. Businesses that are growing have been on the receiving end of, particularly if you're in retail, etc. You've been on the receiving end of the government handouts. You're still ratcheting up the risk. So there has been an increasing appetite for your sort of products that assess risk.
Yeah, and it was really interesting. At the very onset of COVID, the general perception of risk was very high, where there was a lot of uncertainty. A lot of businesses expected the risks to be very high, and they acted accordingly. Then as all of the stimulus started flowing through, that kind of subsided a little bit, where people started seeing less risk. And I remember it was only, I think back in September was the first time I had a phone call with somebody where I asked them what they're doing about their credit risk, and they said, "What credit risk? There is no credit risk." And that kind of indicated to me that we might be sort of teetering. I've gone a little too far the other way.
Yeah, I mean, I've got to say that, I think the performance on receivables collected a lot better. In fact, they've probably outperformed pre-COVID, particularly with the stimulus. People were paying their bills, particularly given that a lot of them don't seem to be paying the ATO. But look, we will come back to that. We'll just we'll introduce our next guest, and we'll put you back in the waiting room, Patrick. And our next guest is Darren Anderson. And Daren is the Managing Director at ERA Legal. I guess, Daren, you have had the luxury of getting more into the property lending space. So that's probably gone well for you this year?
Yeah, it has, Nick. It was pretty tough after the first lockdown. Things got a bit tough. But over the course of the last 12 months, the property lending market has really skyrocketed. So that's been a big saviour for us. I think we're back averaging. We're doing about 100 million in financial settlements a month at the moment.
Wow. And that's all private book, of course. That's all funds
all non-bank lending across a array of lenders, including construction finance. Construction finance is pretty fluid at the moment.
Right. When you say it's pretty fluid, it's obviously pretty fluid in the non-bank space. It may not be so fluid in the bank space.
Yeah, well, I think it's fluid in the non-bank space. That's why we're getting so many deals through.
Yeah. I mean, and are you able to sort of gauge, the deals that you're looking at, the refinance versus, acquisitions and development? It's skewing in any particular direction?
The construction finance isn't refinance. It's usually original loans because the developers and builders are finding it difficult getting finance from the banks. The other non-bank lending work, the real property loans, it's a bit of a mix, probably 50% refinance, 50% original lending.
And I just want to say, I see Dr. Peter Ellis's comment, and I'm not touching that one. It refers to certain missing letters of the Greek alphabet. I see you, Peter. I'm not touching that. So, Daren, obviously everybody in corporate restructuring, generally there's not a lot of it around. There's not a lot of VA activity. There's an uptick in liquidations, and we'll come to that. But a lot of lawyers say that their commercial litigation has still been pretty strong.
Yeah, commercial litigation has been really strong as well. So here at ERA, we were traditionally a commercial litigation practice with an insolvency focus. Obviously, the new insolvency work has been very dry ever since COVID hit, which is, as we all appreciate, is the opposite of what people thought was going to happen. So there's not much of that, but there's still some legacy litigation, and looking at what we've been doing at ERA, we've been looking at liquidators' files that they may have passed over due to them being busy, and we've actually picked up a fair bit of work through opening up dormant liquidator files, which has been a good source of work for us.
So actions that they haven't pursued in the past,
and actions they may not have thought about. So we've got a service here at ERA where we'll go along to insolvency practitioner's office and have a look through their files and see if we can identify any claims that may have been overlooked, and that's been a good source of work over the lockdown.
And just very quickly, does litigation funding play a role in any of that, or not?
It seems like there's a new litigation fund popping up every week now. So yeah, fortunately, we've been able to get a fair bit of litigation funding in those matters, which is great, rather than do all matters as we traditionally would do on a purely speculative basis and wait to get paid over a number of years. So the litigation funding, it's also quite fluid.
I'd love to ask you whether or not you think it should be capped at 30%, but we'll leave that at the moment because that's very controversial. We'll just pop you back in the waiting room and we'll introduce our next guest, Scott Langdon. G'day,
Thanks,
Scott.
Nick.
How are you?
Yeah, really well, mate. And Merry Christmas to all your listeners and watchers. It's been a hard year for us all. So I think everybody's certainly looking forward to some time off and spending time with family, friends and loved ones.
Yeah. For those of us that may or may not have spent too much time there already. Scott, you're a partner at KordaMentha. You've been on our show a couple of times before, and we're always very grateful for you to come along and share your wisdom. Your business has transformed a little bit in the last sort of 18 months. It's less corporate restructuring and more, capital advisory, or how would you describe it?
Yeah, Nick, thanks. So the way we would think about the last 24 months and the way our business is structured is into three separate boxes. And one is your traditional insolvency and restructuring advice and investigating accountants' reports. Second is in regulation investigations, regulatory work. And then the third would be in M&A, both debt and equity. Broadly, our services fit into one of those three boxes. And it's fair to say that this 12 months in particular, but 24 months, the traditional insolvency restructuring advice has formed a very, very small part of our practice. Interestingly, the regulatory side of our practice has increased and doing a lot of dispute resolution work, advocacy work for trying to mediate outcomes. And then the third part of that M&A, with so much cash being around in the market, refinancing organisations, finding new debt, finding additional debt, it's become a really big part of our business, and also selling equity of businesses as well. So yeah, that's how we think about our business. But the last 24 months, the lack of insolvency and restructuring work has made up for the regulatory and dispute type work, and a very big growth in the M&A of debt and equity.
Well, I guess your involvement with Virgin is a classic example of some of what you're talking about. And definitely there's an overlap between skills in insolvency, particularly as you get further up the food chain, I suppose, and M&A, when it comes to all the due diligence and figuring out what's really going on in a business, I guess on both sides of the transaction, buyers and sellers.
Yeah, absolutely.
Particularly buyers, I suppose.
Yeah, I think both sides as well, because we generally, everyone in our industry, whether you're a financier, a lawyer, an insolvency practitioner, we come in times of chaos and times of challenge, and that's what we've always done in our industry. And what we are very good at as an industry is focusing on what really matters and having a really critical view on the financial position. So that means that we can quickly assess whether on a buy side what's really important and try and facilitate a transaction, as opposed to worrying about 100 different things. What are the top 30 things we need to focus on, and getting the right structures in place to make sure that the buyer or the seller, depending on who we're acting for, is putting their best foot forward. But it's that critical analysis, and it's that ability to focus on what really matters and really quickly get to the root causes of opportunities and also challenges. Now,
when we at the beginning of COVID, you're good at coining a phrase, the Scott Langdon trademark terminologies, and you came up with the elegant dismount. I don't know if you remember that one, but we haven't really seen so much elegant dismounting, have we? The elegant dismount was the idea that under the cover of COVID, you could just quietly, put your, businesses that maybe weren't performing, you could climb out of them without any loss of face. But that hasn't really happened. And has it become the elegant dismount has turned into, the elegant M&A, or what? Or do you think that they're all just waiting?
Yeah, I think that we did see a couple, especially early doors. I think in 2020, we saw some elegant dismounts of people exiting the market under the cover of COVID. But definitely, you're right, Nick, we haven't seen anywhere near as much as what I had expected, and I think what the market had expected. And I think it's simply driven by the liquidity, whether it's government support, stimulus, landlord support, ATO forgiveness. So therefore, these zombie companies that might have otherwise done an elegant dismount, they say, you know what, I've actually got cash, I've got options, I can extend my working capital. You know what, I might keep going. And I think it's the access to cash, the extending of terms, and the forgiveness or the very, very generous terms from financiers that has enabled them to sort of hang out a little bit longer than what we probably previously would have anticipated. But do I think there'll be more elegant dismounts in 2022? I think 2022 is going to be a really challenging year. I think businesses are going to find next year much more difficult than the year we've just got through, ironically.
Yeah, I guess, I mean, the thing about all this extra cash, and again, the government's, extending its loan scheme by 6 months. It's a matter of, are we just giving someone money so that they can sit at the poker table for an extra little while, to see, or is that money being invested in their businesses to make them better businesses? And there's a whole debate we could have around that. But look, we might tackle that as we go through the chart. So listen, why don't we bring everybody back? And let's ask Patrick to hit off with his first chart. Let's see what you've got for us, Patrick.
Yeah, thanks, Nick. So what we're looking at here is basically monthly insolvencies, and the orange bars there show typical numbers pre-COVID, and the blue bars show the current numbers. So what really stands out here is that in November was basically the first month in the last 6 months where there's been an increase. It was about a 20% increase over the October numbers. So just back to what we spoke about a minute ago, where the perception of risk had waned quite a bit, and what we've seen is just in the last month or so, it started to pick up again, where we're definitely seeing and hearing a bit more concern.
Do you think is the optimism misplaced, or is
Look,
there?
I think to a certain extent it is, in the sense that we're seeing the tide turn a little bit already, even with the ATO still basically not doing anything. So even with the ATO on the sideline, we're starting to see the tide turn a little bit. And you could only imagine that once the ATO does sort of re-enter the fray, it's going to be quite challenging, as Scott said, for a number of businesses.
Well, just for our podcast listeners, I better explain this graph. So we've got a graph here that's got, it compares 2021 insolvencies for July, August, September, October, and November, but it's also got a composite of 2017 through 2019 being the 3 years prior to COVID. And what it shows is that there's quite a gap between the number of insolvencies during July, August, September, and even October. And as a matter of fact, insolvencies have been declining in 2021 until you get to November. And in November, there's a jump up in insolvencies. And in fact, November, the blue, which is 2021, seems to be starting to catch up with the orange. So, Darren, do those numbers surprise you at all?
They don't surprise me. I was always thinking the blue was going to come back a lot quicker. They don't surprise me anymore, I should say. But I thought the blue might start to creep up. I expect in the new year we'll be back with probably more insolvencies than we might have had same time a couple of years ago pre-COVID, because they're going to have to work their way out of the woodwork at some point. And I think after the election, which I think is going to be in around March or thereabouts, after the election, the ATO will probably start on the recovery process, I would imagine, and things will pick up. One thing of interest, I was speaking to an insolvency practitioner last week who's has a particular focus on safe harbour work, and Scott might be able to tell us what his view is about this or his experience. But the safe harbour work has essentially dried up completely over the lockdown.
Absolutely, and maybe just as an observation, Nick, is that we got the pre-COVID numbers and we've got the COVID numbers. If you actually got the pre-GFC numbers from over a decade ago, that bar would be probably 4 times the size of the yellow number. And we've had a decade of declining insolvencies as a nation as interest rates have become lower, and it's not just a national thing; it's a global fact. And the data is overwhelming. As interest rates have gone down, cash has become more available. There have been less insolvency events. So, in my prediction of what next year looks like, there's two sort of different views. One is that we've actually got a decade to make up, and that pendulum might finally swing with a bit of interest rate pressure and a little bit of pressure from the ATO. But the flip side is that, it feels like Australians and its small businesses are actually feeling quite wealthy at the moment. We've had 2 years of property prices increases, and depending where you are in the country, your collateral supporting your SME loan might have gone up by 30%. The data shows that Australian banks are sitting on more cash than they've ever before. So the individual has got savings more than they've ever had before because they've been propped up by government stimulus. So I've got, on one view, I think that the pendulum might swing really hard next year. We've got a decade of a very low period of interest rates and low period of insolvency. But the flip side is that people do have wealth. 30% property prices broadly increased over the last 2 years does give small businesses greater optionality than what they would have had beforehand.
Well, there's no doubt that in the past, and I'm thinking back into the pre-GFC times when property prices were increasing, and even then there was innovation in the mortgage market, and that was competing with insolvency at the small business end because, instead of facing their problems and restructuring their businesses, people were able to borrow against the family home and kick the can down the road. There's a couple of interesting things that you say there, Scott. I mean, for one thing, leaving aside the fact that you say the disparity pre-GFC is much greater, even just on these numbers here, there's a gap between 2021, and I've said this before, and the average of the previous 3 years. Theoretically, that gap represents a lot of companies that are overdue for restructuring. The other thing is, I was thinking, we've had Warren Hogan on the show once earlier this year, and he's the chief economist at Judo Bank. And I know that he talks about how much cash there is, sitting on balance sheets, and he tends to be more optimistic about things. But I think he would concur with some of your observations there. And I think he would say he's done studies of insolvencies globally since the GFC. And I just wonder whether with all the money printing since then, it's held things up. All right, listen, the other just quick thing I wanted to ask both Scott, well, everybody really, we'll start with you, Scott, and then we'll go back down. Those numbers, what I'm seeing, and this is only anecdotal, it's more liquidations, being companies that are closing the doors and good night nurse, versus voluntary administrations where people are just calling time with their creditors while they reorganise their businesses. What do you think about that, Scott? My fear has always been that businesses disappear forever as opposed to reorganise, restructure and power on.
Yeah, I think that's exactly right. I think that's a really sage observation, that companies aren't going into voluntary administration, then trying to pull a deed of company arrangement out or try and sell their business. Companies are, and in that SME in particular, but broadly, are going straight into liquidation because they feel like there's no optionality. That debt wall has just got bigger and bigger over the last 2 years, where they've got an ATO debt, they've probably got a landlord debt, they've extended suppliers, etc., etc. That debt wall has now got too big that they can't even see a way of restructuring. And I think that's a trend we'll definitely see in the year to come. And just picking up on the idea that there are these zombie companies out there, I think that the insolvency has to increase for the benefit of the economy. Wage growth seems to be a term that's been played out so regularly from our politicians and driving policy throughout 2020 and 2021. And with zombie companies, it doesn't drive wage growth, and it creates stale organisations, and it doesn't create productivity. So I think there is some good for the economy to see the insolvencies increase, to encourage productivity, and that will ultimately lead to wage growth.
Well, one of my favourite economists, Schumpeter, talks about creative destruction. Basically, in a market economy, you have companies fail, but that means that the resources, labour and capital, are redeployed. And that is one of the problems that we have, is that labour and capital aren't being redeployed. Instead, you've got companies that are operating really well, competing with these companies. But that's another issue. Nicholas Bishop says he'd love a slide pack, and I would say to anybody who's wondering the same thing, yes. We will make sure that Patrick, the Alares latest article is in our show notes. So if you go to the show notes, we'll have the latest write up by Patrick, and we will share that with you. Darren, do you think that the advice that lawyers are giving more around how to protect your personal assets when the ship goes down, as opposed to how to save the business? Or
I don't think when you're not getting the inquiries, Nick. That's the issue. You usually you'd have pre-COVID, you have people coming to see you from time to time, seeking advice about their company potentially being insolvent. You give them certain advice, but those inquiries just aren't being made at all. So can't really answer the question because the inquiries aren't being made.
All right, well, let's get to Patrick's next slide, which is court actions filed by the big four banks. So generally, one thing that drives a corporate restructuring activity is the banks looking to take action against clients that aren't performing. So just talk us through these numbers, and maybe, if it doesn't mean giving away the Colonel's secret recipe, how are these numbers compiled?
Yeah, so what we do is, obviously within our data we track court activity throughout the country in all of the different jurisdictions, and what we do is we look at any matters that are filed by the big four banks, and we consolidate that data into these graphs. And what you can see here is plenty of activity right through to April 2020, which basically marked the time that the banks all instituted their loan deferrals and their concessions and what have you, where they basically took the foot right off the pedal in terms of court recoveries. And that stayed that way right up until April this year, where the first sort of major wave of COVID lockdowns and restrictions eased, and we saw that the banks sort of fairly quickly got straight back into it in terms of recoveries through the courts. And then interestingly, after July this year, there was a notable drop-off again in August and September, and that coincided directly with the extended lockdowns in New South Wales and Victoria. Yep. And we had expected, once those lockdowns eased, that the banks would again get back into it, and they certainly have. So October and November have seen some clear increases again, and we're basically now back, more or less in line with where the banks were pre-COVID.
Scott, a firm like KordaMentha would have lots of conversations with the major banks. What do you think about those numbers? And do you think, the bankers that I have spoken to some bankers, and they're still sitting on their hands as nearly as I can tell. So these numbers surprise me a little bit. What do you think?
Yeah, me too. There's no doubt that increase is a little bit more prevalent than what I would have expected from what we see in the market. And without doubt that banks have taken a longer term relationship view, tried to work hard with their borrowers to ensure that they were given every chance of getting through, looking at deferrals, definitely taking a good long-term relationship perspective with their borrowers and being very engaging. And in fact, Nick, I think a number of the workout teams within the banks have actually reduced the size of their practices throughout 2021. So it's slightly surprising to see that increase. But and one of the reasons we'll probably talk to it a bit later is that the government guarantee around new loans and to work with the banks to facilitate new money into SMEs. So that's another reason why I'm a bit surprised by it.
And just a question I'm curious about, Scott. I was talking to someone who had a theory that the files were being managed more in risk areas of banks as opposed to workout areas. What do you say about that?
I think each bank has their own unique modus operandi of working with distressed borrowers. Some have very early intervention, and it goes to a risk team, or it could go to a workout team. They all have a very unique way, but I think one of the positives for longer term success of transforming distressed companies has been this COVID period has forced banks, financial institutions to have front-end conversations with their workout team a lot more aggressively and a lot more directly than what they've ever had before, because so many of the borrowers, faced financial challenges when COVID hit. So I think for the longer term better outcomes, the banks are actually better streamlined. They're having better conversations more broadly, which I think can only be a good outcome for borrowers and to enable them to get through their financial challenges.
Daren, do these numbers surprise you at all? Is this what you're seeing in the court lists? And I mean, I wonder. I was expecting that we would see more of this activity in the non-banks, as the non-banks have been refinancing the kinds of exposures or more likely to become problematic. What do you think?
Yeah, they surprised me a little. It's my understanding was the bank was going to dovetail in behind the ATO, and the ATO started doing recovery work. They surprised me a little. I'm not really seeing them. It could be some matters have been filed by the banks, and they're sitting on them. They haven't served them. I don't know why they wouldn't serve them, but they do surprise me a little. But I think again it will ramp up in the new year. It'll fall off in this December, as it always does, because the courts close down. But be interesting to know what the makeup of those cases are, whether they're possession applications or.
We'll ask Patrick maybe to give us a bit of a behind the scenes there. But just before we do, we just coming to the sort of the final quarter of the show. So if you want to ask any questions of our panel, please do. We will send you out before Christmas one of our lovely Hermes lunch money mugs. And the other thing is just a reminder to share, like, or subscribe to our show, and so that you don't miss any of the updates. All right, so Patrick, just going back to that graph, you heard the comment from Daren. What are these numbers? Are these filings versus actual actions, or is something?
So these are basically new court filings. So the bulk of them are monetary claims, with a few winding up applications and a couple of personal bankruptcies sprinkled in as well.
But are they necessarily served or?
Yeah, look, they generally would be. So once they sort of get filed in court, you would normally serve, sort of around the same time. So some of these matters may well be not due to be heard until sort of sometime in the new year.
Right.
But they've certainly been lodged in court.
Okay, well, look, we are running out of time. So let's go to the next slide, which is this one. Now, this one surprises nobody who is involved in the corporate restructuring industry. What we've got here is a graph that shows all winding up applications, including the tax office and not the tax office. The tax office is in orange, and all other wind-up applications are in blue. And what you have is pre-COVID, you've got the ATO certainly with the lion's share, if not sometimes half of the court actions, certainly a very significant portion of them. But then COVID comes along and the orange part of the stacked bar chart almost disappears. And
maybe
anecdotally, I'm here.
Maybe everyone's paying their tax.
Yeah. Well, I think there could be a combination of people being cashed up and paying their tax, but I don't think so, Daren. I mean, we've certainly seen a lot of small businesses, small and medium, particularly sort of the medium, companies that are turning over 10 to 30 million, say, with very large tax debts. What do you think? Well, firstly, Patrick, is there anything quickly you want to say about these numbers?
Yeah, look, I guess it sort of speaks to itself. But as you said, Nick, historically the ATOs sort of accounted for approximately half of all winding ups. They're still effectively at zero. But what you can see is all of the non-ATO winding ups are basically back to where they were pre-COVID, which is quite interesting.
Scott, what do you make of this, and what do you think the ATO is up to?
I think
they're up to nothing.
I think what's really interesting about this slide is how quickly the non-ATO has come back, and because obviously last year we had these restrictions around being able to enforce stat decks and so forth. I think that it's bounced back really quickly, and part of it might be a legacy trying to flush through and normalize. But what I think it also shows is that people who are owed money, they need the working capital challenges of businesses are incredibly challenging at the moment, and they're only going to be tougher in 2022 when the supply chain challenges, which are also only at the first phases of. So I think it also shows that businesses out there who do have debts owing to them, they will actively pursue them because they need it for their own balance sheet. I think that's really interesting to me.
I just wonder whether the ATO, as a result of this and as a result of the delay, are going to adjust their receivables policy. As you may know, Nick, the ATO has quite an extensive receivables policy, and if you break that policy down to bare bones, what it essentially says is the ATO won't compromise on prime debt. Right. It would rather, if a company owed the ATO $100 million, and the company said all we can do is pay you $90 million, that's the best we can do, the ATO would generally proceed to wind up just for the sake of the extra $10 million. Now, because that is their policy, they give you plenty of time to pay it, but their policy is that they don't get all their prime debt back, they proceed to wind up. I think that policy will just have to change because of the accrued debt.
That is fascinating. Yeah, that's fascinating you say that, Darren. I mean, yeah, you quite, I mean, yeah, I've certainly, you know more about it than I do, but yeah, I'm told that, you can do a deal with the ATO that they will waive a portion of the interest, the general interest charge, but they will not touch the principal amount owed. But you're saying that as a result of all that, once again, you can imagine how much orange there should be on that graph. And if you added that all together, you're saying that they will need to look at it's quite feasible to think they might be looking at actually compromising the principal.
Well, otherwise we'll have to open up some new courts or appoint a stack of new judges or registrars in order to deal with the backlog, because as that debt accrues in the background and people have forgotten about it, you get to a point where they're never going to be able to pay it. So they'll have to be. I'd be surprised if there isn't a policy change to allow the ATO or the recoveries officers to compromise on prime debt, given the extraordinary build-up of debt.
What do you think, Scott?
Yeah, I was going to say at the smaller end of town, I think that we might not see it actually go back to those 2019 levels, because I do know a lot of borrowers have engaged in payment plans, and I think it's a good initiative that the ATO, you can execute a payment plan with the ATO without ever speaking to an ATO employee for under $100 all online. And if you break up those yellow bars, my guess is that probably at least 80% of them would be debts under $100,000. So if those borrowers, those organizations who have got ATO debt of sub $100,000, they can just do that all online, and that might actually delay at the smaller end of town. But fascinating, through COVID, you can execute a payment plan with the ATO for under $100,000 without ever speaking to somebody.
Well, I think I looked at it a couple when the ATO put out its annual report. I looked at some of those numbers, and I think from the top of my head, there was something like 400,000 payment plans in the last financial year. And I think that there was something like 1.4 million payment deferrals. So the stats were huge. Okay, listen, let's hit the last slide before we wrap up. Talk us through this one.
Yeah, so what this shows is court actions filed by the ATO, and as we know, as soon as COVID hit, basically the numbers sort of fell right down to effectively zero, and we've broken this one out into three different categories, being winding ups, which we just spoke about, but also money owing claims and personal bankruptcy petitions, and you can see that all three have basically gone to next to nothing, and they're still there. So whereas the banks have started pursuing court recoveries again, the ATO is still effectively out of the game.
But Patrick, I note that you exclude the great state of Tasmania from your reporting data. I'm just wondering now that they're about to have their first Ashes test, whether you might include them next year in your reporting data.
Tasmania will be included at some point next year, yes.
Well, if Jackie Lambie is watching this podcast, she might have something to say. Patrick.
Apologies to anyone in Tasmania, but I can certainly vouch for the fact that the numbers don't move the needle too much in terms of the graphic.
Give a shout out to Jackie. Can I give a shout out to Jackie Lambie while I'm here?
Yeah,
Nick?
please.
I think she's doing a great job holding the government accountable.
Yeah. All right. Well, okay. Scott, any thoughts on those? On what you're seeing there?
No, nothing that's of interest. I think that 2022 will be a challenging time for the ATO when with the election coming up. Everybody knows that the size of the debt the ATO is just getting bigger and bigger, and how do they take steps now to collect a loan book which has never been as big as it has before? That's going to be tricky terrain for the ATO and politically tricky over the next 24 months.
Well, Darren suggests that they might write some of it off.
I think it's going to be a really big question to be had. I think it's well known that they don't write off core debt, but unless it goes through an insolvency process, I think that's something that absolutely needs to be looked at. And that's in the spirit of what the ATO has been doing over the last 2 years.
Now, my sort of spies tell me that at the accountant level, so not the lawyer or the insolvency practitioner level, but just at the suburban accountants are receiving a lot more letters from the ATO inquiring, rattling the sabre, if you like, certainly making themselves known. I also was told by somebody that the ATO has been hiring lawyers for their debt recovery area. Have you heard any of these sorts of anecdotes, Scott?
Absolutely. There's no doubt there's more correspondence that's come from the ATO to organisations in the back half of this year, reminding them of what their tax position is, encouraging them, if they cannot pay their obligations, to reach out and try and agree a payment arrangement. But there have been very limited notices of demand or letters of consequence that have been issued. And hiring, I think that it's reasonably well accepted that they are upskilling their staff, and I think that goes back to what I just said around 2022 will be a tricky terrain for the ATO to work within.
All right. Well, look, by way of wrap up, we're going to start with you, Scott. When does it happen in 2022? When do we start seeing a return to normal in the restructuring stats? Is it the final quarter of next year? Is it straight out of Christmas? Do we wait till after the election? What's your tip?
I think it'll be a very slow return. I don't think it's going to be a step change in 2022, 2023. I don't think we're going to see a booming insolvency market at all, but I do think it's going to be a really tricky market for organisations. I think that the debt stack of businesses has never been higher coming into the year. They're going to have ATO debt, landlord debt, supplier debt, potentially over 24 months. So their debt load will be higher, plus supply chain challenges, both leads into a working capital challenge of how to manage cash flows for 2022, 2023. And I think that will be extremely hard on businesses. And I think that the increase in insolvencies could come from this working capital challenge being too great, and organisations saying, you know what, I just can't see myself getting over this debt load, and just managing my day-to-day cash is really challenging. Businesses will have to trade for a long time to make enough profit for the potential debts they've incurred in the past 24 months to pay them back.
Well, we haven't even touched on inflation. I mean, if inflation really is 6 or 7% and official rates are, point something, then, real interest rates are well into the negatives. And, if in the US or in Europe or in Australia, the central banks decide to raise interest rates to counter inflation, because eventually it becomes irresistible. Eventually they have to do something. Then we'll see. What do you think, Darren? I mean, you've been fairly bearish on corporate right from the get-go. You said that things are going to be very slow for a long time, and you've been spot on. What do you read for the next 12 months?
Yeah, I think when the Reserve Bank starts to be honest about inflation, the cork's really going to come out of the bottle when people realise that they're going backwards. I paid, I think, $2.10 for a litre of petrol about a week ago. How we don't have inflation when all the prices around me seem to be going up on a daily basis, I don't know. But I think that's a real problem. And as Scott said, there's been no wage growth for a long time, so it's just not sustainable. The ATO is not collecting our money. I think we're in for a whole world of pain for a few years to come.
Yeah, it's interesting. I mean, obviously, inflation is, in my mind, is caused by all the government stimulus. All this money that's been printed is going to feed into inflation at some point in time. That will feed into interest rates. And the other thing, something that we all understand, but that isn't something that's talked about in the papers. When you've got whatever the number is in uncollected tax, I mean, that is a stimulus. That's a stimulus to the economy. It's a hidden stimulus. It's a stimulus that everybody in government knows about, but nobody talks about it. But anyway, Patrick, what's your call for next year? When and what?
Yeah, look, I agree with Scott and Darren. I don't think we're going to see a so-called avalanche or tsunami of insolvencies. However, I do think that things will slowly start to return to more typical historical levels. I think the government will be compelled to do anything possible in the next few months through to the election to keep the economy and sentiment quite buoyant. So I think more than likely it will be sort of towards the middle and second half of next year that we really start to see the impact. But I see towards the end of next year, I would expect things to return to closer to historical levels.
Okay, all right. Well, look, we've kind of gone over time, so we will wrap it up right there. Thank you very much, Patrick Schweizer, for once again sharing your data and giving us a look behind those numbers. And we will. You don't mind if you've shared it on LinkedIn, so you don't mind. We'll put a link in there to your
absolutely.
latest report.
Yeah,
thanks a lot, Scott Langdon. It's great to have you, and thank you very much for joining us and sharing your wisdom. And Darren, as always. Thank you for coming along. So thanks to everybody. Thank you very much to everybody watching live and to anyone who's listening. If you celebrate Christmas, then have a happy Christmas. And to everybody, have a great festive season. Make sure you use plenty of sunscreen, and we will see you in the new year. Cheers.